There are years in history that look ordinary from the outside, but are catastrophic from the inside. They are years where the machinery of power is rearranged so completely that nothing afterward resembles what came before. Yet the people living through it barely notice. 1913 was one of those years. In just 12 months, the United States government accomplished three things that its founders had specifically designed the Constitution to prevent. It handed control of the nation's money supply to a private banking cartel, established a permanent claim on the income of every American worker, and removed the structural mechanism that kept the federal government answerable to the individual states. The country that emerged from December of 1913 was, in a fundamental constitutional sense, a different republic than the one that had entered January. Most Americans learn about these changes separately, framed as unrelated reforms. The Federal Reserve is taught as a response to banking panics, the income tax as a response to inequality, the 17th Amendment as a democratizing reform for the Senate. However, when you examine who was in the room, who funded the campaigns, and who drafted the legislation, a different picture emerges. It was not a conspiracy theory, but a coordinated transformation carried out largely in the open by people who were quite clear about their goals. The story begins not in Washington, but on Jekyll Island, Georgia in 1910. A group of the wealthiest men in America, representing names like Morgan, Vanderbilt, and Rockefeller, gathered in extraordinary secrecy. They used first names only and told no one where they were going. For 9 days they drafted what would become the Federal Reserve Act. These were not disinterested reformers. They were the representatives of the banking interests that would directly benefit. Frank Vanderlip, president of National City Bank, later admitted that if the public knew a banking bill was written by bankers, it would never have passed. The Federal Reserve was sold as a way to prevent banking panics like the one in 1907, yet the institution created was neither a government agency nor a private bank. It was designed to be both and neither. The 12 regional Federal Reserve banks are technically owned by member banks, which receive guaranteed dividends. While the Board of Governors is appointed by the President, the critical decisions regarding interest rates and money supply are made by the Federal Open Market Committee, which includes regional bank presidents selected by the banking interests themselves. This created an institution that could deploy the power of the federal government while remaining insulated from democratic accountability. The Federal Reserve Act was signed by President Woodrow Wilson on December 23, 1913, just 2 days before Christmas when most of Congress had left for the holiday. But the Fed cannot be understood in isolation. It required the 16th Amendment, the federal income tax, which was ratified in February of that same year. For most of American history, the government was funded by tariffs. This meant the government's revenue was tied to international trade and foreign manufacturers. The income tax changed the government's relationship with its citizens. The government's fiscal interests were now directly tied to the productivity and wages of the American workforce. When the income tax was first introduced, advocates promised it would only apply to the very wealthy. The initial rate was just 1% on income above $3,000. However, within 5 years, the top rate reached 77%, and within a generation, it expanded to cover almost every worker. Once the infrastructure was in place, it was repurposed and expanded by every subsequent administration. This fiscal dependency between the government and the central bank meant that the Fed's decisions on money supply directly impacted the government's tax revenue, and the government spending impacted the economic conditions the Fed managed. The third transformation was the 17th Amendment, ratified in April 1913. This changed how U.S. senators were chosen. Originally, senators were selected by state legislatures to ensure that the states had a direct voice in the federal government. This was a deliberate check on federal power. A senator answerable to a state legislature would naturally resist federal overreach that threatens state authority. By moving to popular elections, that structural check was removed. Senators became answerable to voters and special interests, giving them the same incentives as the House of Representatives to favor federal expansion. All three changes, the central bank, the income tax, and the popular election of senators, removed the most significant constraints on the federal government's ability to grow, borrow, and centralize. This was not a partisan achievement. Both parties have since used these tools to expand federal power. The progressive movement of the era included genuine reformers, but it also included members of the financial elite who understood that a centralized government was easier to capture than a decentralized system of sovereign states and regional banks. Woodrow Wilson himself noted that the biggest men in commerce and manufacture were afraid of a power so organized, so subtle, so watchful, so interlocked, so pervasive that they dared not speak against it. He said this while signing the very legislation that consolidated that power. In the decades following 1913, the consequences were clear. The Federal Reserve presided over the credit expansion of the 1920s and the subsequent contraction that led to the Great Depression. The income tax became a comprehensive withholding system, and the Senate lost its role as a guardian of state sovereignty. None of this was inevitable. It was a series of choices made by specific people under specific circumstances. The genius of structural change is that you don't have to convince people to accept it forever. You only have to make it normal. Once a system is normal, it becomes nearly permanent. By December 1913, the architecture was in place. When World War I arrived shortly after, these new institutions were put to work funding, taxing, and borrowing on a scale never before imagined. To most Americans today, questioning these institutions feels like questioning the weather, but they are the legacy of a single year where the American Republic was quietly and irrevocably rearranged.